Good day, fellow investors. Benjamin Graham said that the market is short-term and a voting machine, but in the long term it's a weighing machine. And we're going to discuss whether you're voting or weighing with your money, and I really wanted to take the last week's news to put a great perspective on that. Towards the end of the week, the CPI came in, inflation fears seem overblown, so everything is okay, stocks gone up, interest rates down, so nothing wrong. 16 January, S&P 500 up 2%, biggest gain since after the US election, treasuries, rates went down, so suddenly towards the end of the week, everyone was exuberant, everything went great. Just 2 days prior to that, stocks are close to wiping out the Trump bump as rate fears kick in. Then the same time, Ray Dalio comes out and says, I'm worried that the US government will go broke. What can we do to prevent it? The long-term debt cycle breaking the US government. And when things looked negative, stocks went on the downtrend, the enthusiasm was a little bit down, but then immediately as things changed just on one data CPI point, everything was more light, everything exuberant. Even treasuries went from 4.8, everyone was scared that they will reach 5%, a disaster, down to 4.6. And that is the story with bulls that want lower rates and bears that are afraid of higher rates. We will see who will dominate the year, but this is a great example of the short-term market voting and weighing machines. This concept was introduced by Benjamin Graham in The Intelligent Investor, and let's just go through the key factors there, because when it comes to voting, Graham discusses the emotional market behavior, but that is also an opportunity for value investors. Thanks to my assistant for putting this all nice together. You can pause it and enjoy it reading. Also, Graham described the market in the long term as a weighing machine, and that's what we have to do. Look at the earnings, assets, compare it to price, make a fundamental analysis, look at intrinsic value from fundamental data, not market noise, longer term perspective, and we have to be patient to find the right time to buy something. And I think now the market is totally voting. The S&P 500 needs to go to 7,000 to justify Wall Street's projections. The Fed will cut rates no matter what, it doesn't matter, and the economy is doing great, which doesn't make sense that the Fed cuts rates, but okay. If we go to the weighing situation, the S&P is 2 standard deviations overvalued from a historical perspective. Why the heck would they cut rates? And the economy is doing great? Yes, if you allow for the 2 trillion of deficit with the GDP government spending multiplicator helping the economy grow. If not, the US economy is flat at best and has been for the last 10 years. But given the debt that nobody cares, we can just print money, then the economy is doing great. Hoo-hoo. So that's the voting weighing. If we go to the key of the weighing, valuations, the S&P 500 P ratio is here. Has been that high, dot-com bubble, 1960s Nifty 50 bubble, and 90-29, and later in the lows of the depression, but that's because earnings were low. Despite that, Wall Street, as we discussed in their prediction video, is looking at 7,000 points, but Goldman Sachs, at the same time of predicting here down 6,500 points, so still 8% up for the market, at the same time they are predicting just 3% long-term returns for stocks, and that is, I think, too exuberant. Long-term 10-year returns, S&P 500 P ratios, here you have the black normal P ratio and the CAPE trailing 10-year earnings P ratio. And you see it just smoothens out recessions, but when the CAPE is high, returns over the long term for stocks have been terrible. And you have these charts for the subsequent 10 to 15 year returns. When valuations are high, my friends, returns are low. This is perhaps even a little bit nicer. 15-year forward returns, when the CAPE is like this, you can have -2, Japan -4, or maybe somewhere in the max of 4% real returns, really, if things really get well. But yes, this time is different. Everyone is voting that this time is different. Okay. And even there are articles, academics coming out, just an article in the Journal of Risk and Financial Management, why the high values for the CAPE ratios in recent years might be justified. And yes, interest rates went down, which then justifies high rates. Okay, if interest rates go up, then what? But the key is, yes, it is impossible to predict, and if you look just at the last 40 years, interest rates have been going down, the Fed is announcing lower and lower rates, so that's the situation. But the key when it comes to investing is figuring the risk and reward. What if I vote wrong? What if I invest and weigh wrong? If you vote wrong, you will get the following: 50%, and then maybe over the next 10 years you get to a 0, if you're lucky. But this is very possible. However, if you weigh things wrong and you buy when things are cheap, now you would have a 7% dividend yield if you bought the S&P 500 here. So even if it goes up and down, you still own it and you don't do crazy things like that. So the intelligent investor, according to Benjamin Graham, avoids speculation, focuses on intrinsic value. Check the intrinsic value template that we have for free in the links in the description below. Maintain patience and discipline until we find something to buy. Margin of safety, we don't want to be down 50%. We act independently, even if the crowd might think whatever. Embrace market volatility. This up might be down, and then we have to take advantage of that. And prioritize long-term returns. So yes, stocks might be up 10% this year, but if those are 0 long-term, then it's not value investing. And yes, market might remain crazy for 5 years. Risks are increasing in weight with interest rates, inflation. And if I look at the intrinsic value of the stocks we have calculated, the most famous one are, let's say, overvalued or lower than 10% returns. Some are already getting closer to 10% returns, which is something interesting. This template with the links to the research can be found in the description below, or in the intrinsic value or the free course that we have. So this is the voting and the weighing. I believe that, okay, voting can do well, but if there is a reversal in the market fortunes that we have been enjoying for the last 40 years, voting won't work. That's the thing. Value investing and weighing works whatever the market does. That's the beauty of it, and that's why I'm also making this video. If you decide for the next 40 years, I would suggest weighing, and then no matter what happens with the market, you'll do well. That's value investing.